Hey everybody, as a small business owner, you know that running a business is not always going to be smooth sailing. But with the interest rates on the rise, it's becoming harder for businesses to keep their heads above water. Higher interest rates make borrowing money more expensive, which slows down the economy and discourages consumer spending. This means that small businesses will probably make less profits, and it'll be harder for small businesses like yourself to invest in growth, pay employees, or just keep the lights on. And so, it becomes quite the dinner topic. Everyone wants to know what they can do to weather this storm and come out the other side stronger than before, which is why we decided to do this video for you. We want to help you understand exactly why the Reserve Bank of Australia, RBA, keeps increasing interest rates and how you can prepare to stay afloat. Let's start with the basics. Interest rate rises are a normal part of the economic cycle. The RBA has a target inflation rate of 2 to 3%. If it exceeds that, which it currently has at 7.8%, I know, high A, they need to work towards bringing it back down to the ideal range. They need to do this by implementing what's called a monetary policy. The monetary policy dictates how to set the cash rate, which is the interest rate at which banks lend money to each other. Now, monetary policy can be either expansionary or contractionary. Expansionary policy stimulates economic growth and involves lowering interest rates, while contractionary policy is used to slow down the economy and increase the interest rates. So basically, what does this mean? That if inflation is running above the upper end of the target range, it may be an indication that the RBA will raise interest rates to slow down the economy and bring the inflation back to under control. This is because when the cash rate goes up, it becomes more expensive for banks to lend money, so less businesses and consumers are going to want to borrow funds, which slows down economic activity because there's less money in the economy. On the other hand, if inflation is below the lower end of the target range and other economic indicators such as growth and employment are weak, this could signal that the RBA will cut interest rates so they can stimulate economic activity. So the current inflation rate is 7.8%. So business owners should prepare for further interest rate increases until 2024, when inflation is expected to decline to optimal range. But please note, I'm not an economic expert, so this is not advice. The thing is, a lot of businesses have had it pretty good with super low borrowing rates throughout 2021, but now that rate is going up. Loan repayments are going to get more expensive. And it's not just loan repayments that you need to worry about. Rising prices and interest rates can have a huge impact on your business and how it runs. It'll be harder to expand or make improvements when it's more expensive to borrow money. Plus, with the increase in the minimum wage, some businesses might have to raise their prices just to keep up. You might think that my business is doing well, so it doesn't really impact me. Yes, it does, because the people around you and the businesses around you in the economy are slowing down. And as a result, that means that your work will be slower, the money will be slower, and it will impact your business eventually. All of this could mean lower sales, slower money movement, and then as a result, reduce profits for your business. So, what can you do to prepare and stay afloat? Well, there are a few things you can do to get ahead of the game. So I'm guessing that if you're watching this and you're still watching this, you've probably already gotten that dreaded email or notification that interest on your existing loan is due for another increase. So the first thing you should do is speak to your financial broker or mortgage broker and an accountant to review your existing debt. See if there are other loan products you could refinance into to reduce the interest rates or just the monthly repayments. And if there are a few loan features that help you optimize your loan. And if you don't have a reliable broker, ask your accountant or we can refer you one. Speaking to a broker alongside with an accountant could help you allocate your funds to the right places, reduce your interest rates, and minimize your taxes and give you more funds so you can have some legroom. My second piece of advice would be to reassess your business expenses and see where you can save money. There are actually quite a few different ways you could possibly reduce your expenses, but you need to find the best solution for your business. One example would be to check if you're getting the best deal on essential services. Review your contracts like your insurance premiums, phone bills, and internet services. You may also want to consider whether you can negotiate a rent discount with your landlord. But these days, landlords have been trying to increase the rental income as well. Or maybe consider outsourcing some of your non-core business activities because it generally is far more cost effective than maintaining an in-house staff full-time. I know this is a hard decision to make, but it could make or break your business. Trust me guys, if you can evaluate your profit and loss and identify where you're spending the most, you can find creative ways to reduce the business expenses and improve your bottom line. Tip number 3, update your pricing model. Now this one is easier said than done. I was in the same tight spot when it came to the profitability of my business not so long ago, and it can be pretty tough to find ways to increase your revenue without losing sales. But what I can say is that one of the quickest and easiest way to boost your bottom line is by raising your prices. It might seem counterintuitive, but inflation affecting prices everywhere, consumers are actually getting used to paying more. So you'll probably find that consumers are willing to go along with it. Plus, if you can't meet your demand because there's just so many customers, it might be a good idea to increase your prices. Even a small price increase can make a big difference in your margins and profitability. And the last thing on my list is to speak to your business accountant. If you're worried about how the recent rate hikes will impact your bottom line, it's a good idea to speak with your business tax accountant. Accountants can help you assess your current financial situation and develop a plan to navigate the interest rates and price increases. So there you have it. If you want your business to succeed, it's important to be proactive and plan for the future. And remember, our YouTube channel is here to help you do just that. So don't forget to hit that like and subscribe button. Thanks for watching, and we'll see you in the next video.